Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays, the first session of 2024 from our side. Despite 2023 being a very challenging year, to say the least, markets finished on a high note for mostly all asset classes. But what now for 2024? A recession still looming and some analysts still talking of a possible hard landing. Who knows? Markets expect 6 rate cuts from the Fed during the year, with the Fed indicating perhaps only 3 or somewhere in between. Later this year, time will tell. With lower inflation numbers globally, this could be the case for most central banks, including the South African Reserve Bank. But even if they pivot, is it not too little too late? We know that it takes some time for rate cuts to bite and bleed through to the consumer. Geopolitics will always be noisy, and 2024 was probably with no exception, with more than 60 countries heading to the polls this year. So making for some very interesting topics, I'm sure, going forward. Joining us this morning, all the way from sunny London, is Group Director and Portfolio Manager Bradley Anthony from Fairtree Asset Management to look at some of their macro themes and how they consider to plan around this and navigate through them. He will also give us a quick update on the Fairtree BCI Select Cautious Fund, one of the top, if not the top, SA multi-asset low equity funds. Good morning, Bradley. How are you this morning?
Morning, Eugene. Very well. Hope you are well too. And everything the best for 2024.
Likewise, that side, I hope you sit with better weather in the coming months. I believe it's midwinter, 7:30 your side, still looks very dark and grey. So definitely not sunny. But thank you so much for joining us so early from your side. We really appreciate it. And looking forward to your views and your presentation. You can start when you're ready.
Thank you, Eugene. And once again, thanks to you and your team. Such a privilege to be able to to join you this morning. Excuse me. I'm going to take you through, I suppose, the things that we're thinking about, the things that are almost keeping us awake at night. There are a couple of slides that I want to walk through with you and the guests this morning. As I said, some key themes. What are we thinking about? What's keeping us awake? Just touch a little bit on the performance of the fund, and go through again, I suppose, some ideas that we spoke about the last time I had the privilege of sharing with you, just around our philosophy and the testing of our hypothesis in terms of the way we manage the fund. So diving straight into it, I guess this year is all about uncertainty. You know, I was thinking of a rugby analogy that I could share, and I came up short. But one that I did think about is, you know, it feels like we're on the pitch and we're playing, and I'm looking up into the stands, and I'm looking for Rassie, and I'm looking for some lights for him to show me red, orange, or green, or whichever colors that he uses, and there's just no signals up there. So unfortunately, as the rugby analogy goes, we just have to play whatever's in front of us, because it is a very uncertain time. I mean, your intro was so good. I feel like I don't need to go through the rest of my slides, but you encapsulated the thoughts in that there are so many tensions within the world, both positive and potentially negative. So it's going to be a very challenging year. From a macro theme perspective, almost thinking about kind of the key things that we're wanting to keep an eye on. The first top left, just because of the slides design, not in terms of priority, but China and the policy response. What are the challenges that the Chinese economy faces? I've got a slide that I want to share that I think is quite an interesting perspective. And then the US, you know, are we going to thread the needle? Are we going to have a soft landing? You know, are we going to land at all? And not to add to that, of course, the fact that we're going through elections in the US as well. Europe's in a tougher place, but looks to be closer to rate cuts. South Africa, you know, do we lead or do we follow in terms of monetary easing? What are the pressures? And then also maybe just one perspective that I'll share later as well, just sort of the global perspective on South African kind of valuations and asset prices and opportunities from a financial markets perspective. A couple of other interesting dynamics around CPI that we're trying to grapple with globally. We know inflation is falling. Is it falling sustainably? We hear commentators talk about the last yards are going to be the hardest in terms of getting US inflation from kind of 3.5, 4 down to 2, and then all the geopolitical tensions. So the way in which we try to think about the world is we try to think about kind of these 4 pillars. So what is growth doing? What's inflation doing? What are central banks going to do? And then what are the risks out there from a geopolitics perspective? And I suppose this is our base case. and if I were just to pause for a second, we're almost thinking, there's various scenarios around the base case. And I've titled the slide, not if, but when or why. Because the IMF has just come out and forecasted yesterday global growth will be around 3.1%. And that's not that bad. That's all right. So growth is going to be okay. We're not forecasting or thinking from a base case perspective that we're going to go into this deep kind of recession, or but that growth will be okay, but possibly below trend. We are in a disinflationary environment at the moment. Inflation's falling, so kind of a light green tick there. But again, why would inflation fall? Does inflation fall because some of those things that we were thinking were structural when Jay Powell was saying they are transitory? To what extent does inflation fall because the economy rolls over and demand falls off a cliff? Or is it just a cyclical thing that inflation will fall to a lower level? So again, the reasons behind the drop in inflation will drive a lot of financial market behavior. From a central bank's perspective, I think most people you speak to around the globe will say that most central banks have peaked in terms of their tightening cycle. And so we are about to embark on a change in trajectory, and interest rates are about to start falling. So a big green tick for that. And then geopolitics, you may not see that, but that's actually a light shaded red, because there is a risk on the horizon. There's lots of things happening, and we'll talk about that as we go through the presentation. But I don't think it's a deep red warning signal. But then we do have a risk case as well that we have to consider. And in the risk case, all of these things deteriorate. And I think, most importantly, the geopolitics and the inflation could really drive, a negative outcome. So, inflation doesn't fall. It finds a bottom and then starts to rise again, and the structural inflation problem becomes an issue globally. And then I think central banks are gonna have a problem, because if inflation starts to rise, typically growth will start to come off if it's not a demand-driven inflation. And you have the geopolitics in the background. I think could be a very risky environment for markets. The big question is what is priced in. So there's a couple of things that we look at, and I'll just touch on one. We're constantly looking at to what extent do asset prices price in the change in inflation. So to what extent has the fall in, let's say, US 10-year bond rates already been priced into equities? And the relationship there is that if you think about an equity as a series of future cash flows, and you discount those cash flows using sort of a discounted cash flow model, then the rate at which you discount those cash flows has an impact on the present value of those cash flows. So there's a relationship between long-term bond yields and equity prices. And so if you look at the history of where, let's say, PE valuations or some sort of valuation metric sits relative to US 10-year bond yields, the market's already pricing in that the bond yields are going to be somewhere between kind of 3.5% and 4.25%. So this cutting cycle that we're about to embark upon is to a large extent already priced into the market. And that got priced into the market in the last quarter of last year. So we need to be very wary that even if our base case plays out, the ride could still be quite bumpy for equities from here, because a lot is already priced in. But I'll touch a bit more on that in a second. So let's talk about some of these risks. Eugene already mentioned the number of elections out there. Almost half the population of the world is going into the polls to elect a new leadership. There are loads of concerns in the past couple of weeks about the outcome in China. The let's call it the US-friendly party, the Independence Party, won the elections, but got slightly lower representation in Parliament, and so it turned out to be kind of a little bit of a non-event where everybody was very concerned about the outcome in Taiwan. And I think that the risks there remain elevated, but are not that acute that we need to be concerned about it in the short term. Another interesting factor is, people were saying, there may be some Chinese military action if the US-friendly party wins within China. But the reality is that the Chinese military is actually in a bit of a pickle at the moment. Loads of stories and feedback around some challenges which the Chinese military is facing at the moment. So they're in a little bit of disarray. And so any sort of military action from China at the moment, I think, is off the table in the near term. But who knows, that could unwind. I've just highlighted a couple of other elections there, and the most important one is the US, as we all know, coming at the end of the year. From a geopolitical perspective, that is. And it really is a travesty that if you look at the world's largest superpower, that these are the two leadership candidates that they've got on offer. Without any comment on the politics of the two candidates, I said to a colleague jokingly yesterday, it's a pity that the US has got to choose between sleepy and dopey. We've got two leadership candidates that really don't stand out as being the most effective in terms of navigating the challenges of the world going forward. A couple of interesting perspectives. One commentator has been saying that if Trump wins, maybe that's good for geopolitics. And I was like, okay, how do you join the dots on that one? The perspective, and it's just one perspective, I'm not saying I agree with it, but Trump is so volatile. Where Biden, I suppose, is a bit more measured in his response. And so all these geopolitical flare-ups that happen all around the globe, Biden's been a bit more measured in his response, and Trump may not be. And so maybe he acts as the deterrent to anybody trying to stick their head up and do something silly across the globe, because he'll just act in a very volatile way. So maybe his volatility creates stability from a geopolitical perspective. It's an unusual view, but one that's worth thinking about nonetheless. From a geopolitical perspective, there's also a feed through into CPI, and I'm sure all of you have seen this. I'm not going to labor this point, but about $10 billion of goods get shipped through the Suez Canal every day. 4.5 billion going one way and roughly 5 billion going the other way. And with the challenges in the Red Sea at the moment, there's been a rerouting. But look at what's happened to the shipping rates within that channel. How they've just exploded to the upside. So China to Europe, basically up threefold. And that's got to feed through to inflation in some way. Now, we're not facing the same challenges. If you look at the second graph of the year, we're not facing the same challenges that we had during COVID, where there's a complete seizing of the supply chains. But the reality is that we can't ignore the risk associated with these geopolitical risks in the Middle East. So this could actually feed through negatively to inflation. It could keep prices elevated. But at the same time, sound a bit like a stark record. There's a second side to inflation, and I find this view a very interesting view. And again, let me just state, this is not our base case. This is not what we believe will unfold going forward, but it's a thought process which we have to challenge. And this is a thought process which a group called Alpine Macro have put on the table. A lot of you have seen their work previously, I presume, where they're looking at long-term trends in US labor productivity. And from about mid-2005, around there, we've had a decrease in US labor productivity. And that's fallen all the way to an inflection point somewhere around post-COVID. And it looks possibly like there's a turning point in labor productivity. The things that they highlight, though, is that at the back end of the 90s, you had this strong surge in productivity led by a tech revolution. So we had the introduction of the internet, we had the introduction of things like email, and then eventually the introduction of e-commerce, which added to productivity positively. Now, when you have labor productivity, so this is essentially the unit cost of labor decreasing. So for every kind of dollar you spend on labor, you're getting more productivity out of that. So you're getting more product coming out of your labor force. Your unit cost of labor actually falls, so labor productivity increases, and that feeds through to price. So it feeds through to margins, and it removes the pressure on prices to rise. Despite the disinflationary trend that we went through from 2005 for 15 years, the reality is that labor productivity was actually falling through that period as well. And the question is, with this AI, machine-driven, automation-driven tech revolution that it feels we're on the cusp of, whether that actually plays into a new surge in labor productivity, which then feeds through to a disinflationary trend globally. So despite the fact that we have all these tensions playing on prices globally, we could actually be going into a period of 10 years of improved labor productivity, which takes the pressure off prices going forward. The other thing, which is an interesting viewpoint, which has been touted by a guy called Richard Koo from Nomura in Japan, is drawing analogies between what's happening in the Chinese property market and what's happened in the Japanese property market at the end of the 80s, going into the 90s. So in Japan, to remind you all, you had this massive collapse in asset prices or house prices, which led to what he calls a balance sheet recession. Now, for those of you who were around in 2008, there was lots of talk that the US is actually going through a similar balance sheet style recession, and they were also on the cusp of a lost decade, unless US fiscal authorities responded appropriately. Now, what a balance sheet recession is that, from an asset and liability perspective, you have your house price on the one side, you have your mortgage on the other side, and the house prices just completely collapse. Your liability stays the same, and you're essentially underwater from an assets liability perspective. And so as a consumer, when you face that situation, you suddenly become very risk averse. You suddenly start saving instead of consuming. And so regardless of what happens to interest rates, unless those asset prices reflate, you're stuck in this long extended period where there's just no incentive for consumers to go out and spend. And consumer sentiment drops off a cliff, and you just have no demand in the economy. The one ray of light that Richard Koo himself actually highlights is that if you look at what happened in 2008 across the US and across Europe, was a very different experience to what happened in Japan, because I think when Japan faced this balance sheet recession, nobody had thought about this from a typical kind of cyclical perspective. So nobody had thought, what are the tools available to the Japanese authorities to try to bring confidence back into the economy. And so as a result, they grappled with a couple of different things, making a couple of missteps along the way, and house prices just continued to fall. Where in 2008, I think the US and certainly Western governments responded with the informed view that they wanted to avoid this balance sheet style recession. And I was listening to a Chinese economist, who's actually an academic, and you were saying that one of the things that is being taught in Chinese universities at the moment in economics is this whole Japanese style balance sheet recession. So you would hope that the Chinese authorities actually respond appropriately to this and don't allow this absolute collapse in property prices. So that's the big picture. In the near term, we know Evergrande has just hit the wall. We know there's still pressure on property prices. So there is this tension that we've got to navigate, whether they are going to respond appropriately. Because if you look at where Chinese consumer confidence is at the moment, this is the big problem. there's no demand, confidence is low, CPI is falling, they exporting this disinflation. So globally, we could find, again, another force contributing to lower inflation. But the reality is that, China is a massive economy. So from a European perspective, we want to see China recover because of the trade links between Europe and China. From a South African perspective, we want to see China recover. And so we're all waiting with bated breath. So the Chinese have spoken about this 2 trillion renminbi stimulus package. There's talk of a reserve ratio cut coming. But one of the things that the Chinese are trying to navigate as well is that they're trying to position their currency as a second trading currency for the globe. And so if they cut aggressively, or if they stimulate aggressively ahead of any change in Fed policy, there is the risk that the renminbi depreciates relative to the dollar. And they don't want that either. They don't want a precipitous fall in the renminbi because of a response to address their internal growth dynamics. So they've got this challenge that they're trying to position themselves as a potential trading or reserve currency, but they have to try to reflate the economy at the same time. And so once again, threading the eye of the needle, and one that's going to be interesting to watch. If they do respond with stimulus as the Fed cuts, I think the lessons from the Japanese economy is that the response is going to be targeted. So there's talk that the Chinese will probably nationalize some of these property developments, complete some of the developments that have been fully paid up front by consumers, where they've bought apartments or properties and paid the full amount up front, and none of these developments are actually moving forward. And so instead of infrastructure into rail and road and that sort of infrastructure investments, we could actually see the Chinese central government nationalizing property developers. Interesting thought. Once again, I'm sharing the stuff that we're thinking about, that we're keeping an eye on, and it's certainly not our base case. But China's got to try to solve the problem of getting consumer confidence up and turning their growth dynamic around. China is not facing a recession, but in Chinese terms, growth of around 5% or lower is probably equivalent to a recession, because they need to continue to generate the kind of growth to appease the populace as they move forward. So that's China, and then if you try to kind of translate this into South Africa, I thought I'd share 2 slides on South Africa and one anecdote. So this looks at valuations, emerging markets in red, the US S&P in blue, and South Africa in green. And this is just looking at PE ratios. And the thing that stands out is that South Africa has underperformed its emerging market peers. So it's cheap relative to emerging markets and cheap relative to the US. The anecdote I want to share is that we have the privilege of managing capital on behalf of a number of large and very diverse global institutional investors. And so we have kind of first-hand, real-time perspective on how they view our economy and how they view our financial markets, the attractiveness thereof. And unfortunately, we face a lack of clarity in terms of which way the aggregate is going to move, because we've had one investor at the beginning of this month decide that they're going to divest from South Africa. So one institutional investor has exited the market. While at the same time, in this week, we've had another investor actually invest into the South African market. Anecdotally, when I talk to people here in London, I talk about South African asset prices and how they view the South African economy. I think there's interest starting to build in the South African economy. There's interest starting to build in our domestic stocks specifically. And I think that once we see China start to find a base and start to reflate the economy, I think it could be a very attractive backdrop for South Africa. So despite all the kind of local noise we get caught up in, I think that that South African financial assets are quite attractive at the moment to global allocators. It's just a matter of when they actually start to allocate. But it definitely seems as if that is starting to come onto the agenda. What's been on the agenda for a while are South African bonds. And these are 10-year real yields across a couple of emerging markets. This is from a Alpine Macro research piece, once again, just showing where real yields sit. And you see South Africa, sitting over here on the far right. But the attention at the moment, after the rally we've seen in bonds in the fourth quarter of last year, despite this attractiveness, the attention has turned to South America. And so there's lots of talk around the attractiveness of Brazilian, Mexican, and even Chilean bonds at the moment. And so there's always this issue of competing assets that we have to deal with. So from a South African fixed income perspective, we do face a scenario now where attention has shifted. And I think the next leg down in South African yields will be driven by South African investors as opposed to global investors. Could be proven wrong on that, but the attention definitely seems to have shifted away from our local market. So attractive valuations, some interest in our equities starting to build, interest in the bonds have waned a bit, but these could kind of turn on in a heartbeat. So we're going to watch that very carefully and try to get a sense of what global allocators are doing. Just going to touch very briefly on performance. You know all of these things. This is kind of a longer term performance chart from when we took over the portfolio in March 2017. Our mindset is always we want to try to beat our benchmark, which is CPI +3. Over that period, CPI +3 did about 8%. We did roughly 10%. So happy with that outcome. And we've always said in the long run, if we do that, we will bubble to the surface in terms of our ability to compete relative to our peers. And since that March 17 period, we ranked fairly attractively relative to our peers. We try to build the portfolio in such a way that we have a neutral position that we go back to. And it's interesting, Ray Dalio has been talking about the outlook for 2024, and he's been saying that there's opportunity and there's risk in all risk assets. And so what you should be doing from a portfolio perspective is going back to your neutral portfolio. And each investor is going to know what that neutral portfolio looks like. Neutral doesn't mean that you go to cash. There's very little reward going to cash in an environment where central banks are cutting. But what you need to do is you need to understand what strategic asset allocation will get you closer to your end goal, and go back to that neutral portfolio. And that's exactly where we are today. We've gone back to the neutral portfolio, and we, again, looking at the cautious returns, this gives you a sense of the returns that we get out of that neutral portfolio from an asset class perspective. In 2023, just to touch briefly on that, we did move around a little bit because our mindset is always, where do we get the greatest certainty of outcome? And one opportunity that presented itself very starkly in 2023 was the opportunity in global credit. Global credit was running at a running yield of close to 11.5–12%. And we thought that the risk of tilting towards global credit away from SA equity made sense. And so at the margin, you can see the bar charts on the left. We tilted away from SA equities into global credit, and we've reverted back to the neutral portfolio again by the end of the year. That served the portfolio well. We did pick up some additional return from global credit. These are weighted returns, obviously. So the global credit SAA position is a lot smaller than the SA equity position. So you're going to get a greater attribution of returns from equity, but at the margin, we actually made quite an aggressive shift of almost 7–8% away from those SAA positions. I just want to touch in the last kind of 10 minutes, I think that I've got 5–10 minutes that I've got on this philosophy around building a portfolio that has the highest probability of eating your CPI +3 outcome. Hopefully you've taken from the slides that I've shown you around what's on our mind from a macro perspective, that things could go either way. That's just the reality. Rassie is not in the stands with a green light or a red light. We're going to play what we see in front of us on the field. And things could really go either way. We could tilt into a very strong disinflationary environment driven by disinflation from China, some sort of resolution on geopolitics. Growth could continue to be robust, albeit slightly below trend, which is a Goldilocks environment for risk assets. And we could find that equities rally quite hard. Another scenario could be that growth starts to stall significantly because China isn't able to navigate this confidence crisis that it faces. That feeds through into lower global growth across EM and Europe. And maybe with the political risk that sits in elections in the US, that adds to some of the challenges for risk assets. So risk assets could in that scenario collapse. So we're going to be very careful about how we navigate the next period, and be very close to news flow and be very close to outcomes in all of these risk factors. So that being said, we're going to go back to our neutral portfolio. And we're gonna stick with our neutral portfolio for the foreseeable future. So we typically build a portfolio on an SA perspective. We try to be tactical in protecting against large crashes, and then generate alpha out of security selection. And that's what's driven returns over the years in this portfolio. To test this hypothesis, at the end of last year, we did some work where we said, would it be easier to have a buy and hold strategy versus asset allocating between two alternatives? And in this case, the buy and hold strategy would be the income plus capability, and the all bond index would be the other opportunity set. So would you get a better return and outcome over time if you just bought and hold the income plus capability, or if you were able to switch tactically between the two? And I ask people about what they think is the most likely success rate for a good capital allocator, and what's the impact on risk and return if you were to allocate between the two asset classes. So we ran a couple of scenarios. So just to explain what you're looking at on the chart, if you had perfect foresight and you took for the period under review year was just on around 10 years, and you took monthly returns and you said, I'm able to select the best asset class with perfect foresight 1 month forward. So I'm either going to be in income plus or I'm going to be in SA bonds, but I'm selecting the best outcome for the month going forward. And you do that every single month. If you had perfect foresight and you picked the correct asset class every month, that's depicted in the green line. That's your cumulative return and your outcome over time. If you invested 100 Rand, you're going to end up with 588 Rand. If you had imperfect foresight and you picked the wrong outcome every time, 1 month forward, you've lost a bit of money. So you end up with 88 Rand. Your buy and hold strategy gets you 232 Rand. That's buy and hold for income plus. So the point of this chart is that clearly chasing that green line is what we all want to do. It's the holy grail. If we can get closer to that green line and move away from the orange line, that enhances returns for all of our clients. The challenge is doing that, I suppose. What we then did was we said we take 10% increments and we run thousands and thousands of simulations to try to see what is the outcome for perfect foresight, imperfect foresight, and then 10% increments of success. And the reality is that what the lines that you're seeing there are all the means of the distribution of outcomes for a particular success rate. So every distribution of outcome is going to have volatility around that simulated mean. So if you look at the table at the bottom right, you'll see with perfect foresight, the mean return would have been 19% versus a buy and hold strategy of, call it 8.5%. And volatility would have been around 4.5% versus a buy and hold strategy of 2%. Imperfect foresight gives you a mean return of minus 1.8% annualized, increased volatility of 5.8%. If you then try to test, at what point does your probability of success of outperforming the buy and hold strategy, at what point does that exceed or the outcome exceed the buy and hold strategy. And it'll be roughly around this 50% level. But what this chart shows you is that as you start to make those decisions, the standard deviation around your end value starts to increase until you get to a point where you've almost got perfect foresight, and then your standard deviation starts to fall. So your outcome becomes more certain when you have perfect foresight, and your outcome becomes more certain when you have imperfect foresight, but your variability around your outcome increases as your probability of success increases. In order to beat the buy and hold strategy, you need to have a success rate of roughly 53%. So what does that mean? I've said a lot in the last couple of minutes very quickly. It means that you have to select the correct asset class 1 month forward 53% of the time in order for you to beat the end value of a buy and hold strategy. So for you to beat the end value of 232 Rand from the buy and hold strategy, you need to have a 53% success rate. However, the standard deviation at a 53% success rate of the outcome is 29 Rand. So in other words, you could have had 232 plus 29, 232 minus 29 Rand in terms of the outcomes there, which should all be considered standard, a standard distribution of returns. So you're basically increasing volatility to get the same return as a buy and hold strategy if you're hitting a 53% success rate. So I've tongue-in-cheek said that's return-free risk. It's only once you get to 60% success rate does the lower bound of your standard deviation of end values exceed the buy and hold strategy. So you need to actually have a 60% success rate of selecting the right asset class 1 month forward in order to achieve a better outcome than a buy and hold strategy. That does come with some additional risk. It comes with 4.4% standard deviation or volatility. But one would think that 53 or even 60% success rate is not a bad success rate for professional investors to achieve. The reality, though, is that if you look at a 10-year history of the peer group in the multi-asset income space, there aren't any who have been able to exceed or beat the buy and hold strategy. So there's the buy and hold strategy in orange, and this is the entire peer group through to December 2023. So despite that massive rally we saw in South African bonds at the back end of last year, added into that return series, none of the peer group are able to actually exceed the buy and hold strategy. So despite this compelling argument that we've got to pursue the Holy Grail, it's far more elusive than you'd think. So the story is a great story. It's just a difficult one to execute on. And so I guess you'd say, well, okay, that's bonds. What does it look like for equities? If you tested the thesis on equities, run the same scenario, run the same analysis, you're looking at about a 55% success rate before the lower bound of the standard deviation exceeds a buy and hold strategy for equities. Again, that green number, the perfect foresight number over there, is exceptionally appealing. And so, of course, we want to try to do all that we can to pursue an outcome closer to that number over there. But the reality is that it's a hard outcome to actually get to. And if you look at, again, just to remind you, we tend over time to run our portfolio closer to strategic asset allocation as opposed to being more tactical. And you look at the peer group in this low equity multi-asset category, none of our peers have been able to successfully outperform that approach to asset allocation. So I'll end here, and I'll just end with again reiterating the comment from Ray Dalio, who I think is respected amongst most investors. He says, know your neutral portfolio going into 2024. For us as portfolio managers on this fund, we know our neutral portfolio, and that's where we're going to go to. But I guess my word of advice to the audience is exactly the same for your clients, and each of your clients, I'm sure, is different. know their neutral portfolio, because risks abound, but opportunities abound as well. And so being too risk averse, going to cash is not the answer. Being too aggressive in your risk assumption may not be the answer either, because there are a lot of risks on the horizon. And I'll leave it at that, Eugene, and hand back to you.
Brandon, thank you so much for all of that. You've covered a hell of a lot of ground in a very short space of time. Thank you so much for that. One or two quick questions from my side. One speaks to a question from the audience as well. Beginning 2023, a lot of fund managers rang the bell around the China reopening and how that could potentially benefit resources. Chantal, towards the end of last year, she did a good job in showing your positioning around the equity carve-out in the Select or the Fairtree BCI Select Cautious Fund, how you reduced your resource exposure. Views for 2024 going forward, mining and resource companies, you think you might get more bullish on that, or you're going to hold position in a lower weighting?
I think Eugene, we do hold position in a low weighting. I think there's a lot of kind of water to flow under the bridge, for lack of a better expression, before we can assume more risk. I think we want to see China start to do some things that actually are supportive for commodity prices. There've been a couple of interesting developments this year. So despite the lackluster growth, iron ore prices have remained relatively supported and elevated, and that's been challenging, because with iron ore prices where they are, I suppose these resource stocks look a little bit more attractive, specifically the diversified miners. But iron ore does look elevated relative to where it should be against the global backdrop. But if China turns the corner and starts to address some of their property-related issues, then perhaps it makes sense to start to look at some of these stocks again. So currently, we still position very much the way we were at the end of last year. We have a chunky weighting to gold equities, because in an environment where real yields start to fall, as central banks start to cut, we think gold will be supported. And with all the geopolitical risks that abound, we think gold remains a good place to be. So we are still being fairly cautious from that perspective.
Very interesting indeed, and you addressed another question on gold, so thank you for that. Looking at your allocation to global bonds, roughly about 10% in the cautious fund, those global bonds, is that part of your global income plus being managed by Louis and Paul, or is that just global floating rate notes?
No, those are essentially global income plus exposures. So these are global corporate bonds. So it's global credit essentially. Global credit at the moment is still running on a running yield in rand terms, because you must remember we hedge back that currency, so we don't take any currency exposure in the global credit exposure. That's running on a forward-looking 12-month forward-looking running yield of 10.5%. South African credit is running on a forward-looking yield of around 11%. So both South African credit and global credit look very attractive vis-a-vis our return target of inflation plus 3.
Interesting. You showed a chart on interest from foreign or institutional investors around SA equity, not really biting yet. But if you look at SA fund managers, a lot of talk on SA equity. We're seeing a lot of guys buying back into SA equity. I think mainly because of valuations, SA equity appear to be very cheap, very attractive relative to any other market out there. Is it maybe not a reason why SA equity is cheap and can maybe remain cheap for longer?
Yeah, absolutely. I mean, this could very well be a value trap, and the challenge here is that internally we need to get the internal growth dynamic, the internal growth picture looking a lot better. But one of the things that is, I showed, and it's probably my fault, I showed an aggregate view of SA equities, right?
Yes.
But even if you drill down to a sector level, so let's take retail as an example. If you look at retailers on just a PE ratio perspective relative to history, there are some retailers that are quite expensive actually, and there are some retailers that are actually quite cheap. So it really does become a stock pickers type environment. So we are probably underweight retailers as a sector, but within retailers there are some retailers that we really like. So one of the retailers that we like that we are overweight is Mr. Price as an example. We think it's trading cheap relative to history. We think it's trading cheap relative to the earnings outcome or the earnings projection. But there are other instances where they are expensive. So I guess you need to be very wary of value traps. I think there's a lot of idiosyncratic risk that sits in SA equities at the moment. The audience will know there's been some management changes at places like Pick and Pay. SPAR face some issues with some technology implementation costs that they've had to carry. So there's loads of these idiosyncratic risks that are embedded in local markets. And you need to be aware of them. Having said that, as we go into a cutting cycle, as we go into interest rates declining, if China starts to take off and there's broad support for emerging market growth from a global macro perspective, a rising tide will lift all ships. And so you need to be aware of that. You need to be nimble in your process. But as we stand right now, we're still relatively underweight SA Inc. in its totality.
While looking at the stock picking capabilities, and if I only look at history to judge it by, we trust in your stock picking capabilities. So I'm going to park that with you. Very last question. People always want to know about the Rand. I'm not going to go to the Rand side. The past year and a half, it's been a dollar story. If you look at any other currency, euros, yen, and some people call it the year of the yen, but we'll see what plays out there. It's been an immensely strong dollar, and economics 101, if the US starts cutting rates, we should see, dollar losing some steam. However, if we do see more volatility in the market, geopolitics flaring up, possible recession, then that's that argument again, flight to safety and support of the dollar. Your views on the dollar, short to medium term?
Eugene,
not going to hold you to it.
I think you've summed it up. So I think it really does depend on why to determine what. So it's certainly not a mainstream view, but there is a view out there that the dollar and the US government has relinquished its role as an anti-fragile asset. So what I mean by that is that if you look at the extent to which debt is accumulated on the US balance sheet, it's a problem, and that's going to feed into a weakening dollar over time. There are the other theorists on the other side of the table that talk about MMT. The talk of MMT receded. There was all this wild enthusiasm about modern monetary theory a couple of years ago or a couple of months ago. But the reality is that the underpinning theory of MMT is that if your nominal growth levels exceed your interest rates, you don't get yourself into a debt spiral, and you are actually able to borrow at exceeding higher levels of debt to GDP and not going to a downward debt spiral. And you see that in Japan. If you look at the debt to GDP levels in Japan, there's no risk of the Japanese fiscus imploding. The challenge with the yen has been more an inflationary challenge, so deflation as opposed to inflation. So again, as I said, it depends on why. So I think base case, you're right. The dollar's got to peak out, and it's got to start rolling over relative to all crosses. So relative to yen, relative to euro, relative to sterling, relative to ZAR. So in that scenario, I see a bit of rand strength. But then we've got the idiosyncratic issues that we've got to deal with from a South African perspective as well. So I'm loath to say, rand strength. I was talking to a client at the end of last year, or somewhere around November, I think it was, and And they said, where could the rand go to? And I said, well, it's definitely not going to 18. And I think it hit like 18.06 or something. You know? So I proved to be right. It didn't go to 18, but I mean, you know, nobody knows these things anymore. It's hard to call the rand. It could go anywhere.
Got to keep at it and on it all the time. Bradley, extremely insightful, and thank you so much for your time this morning. I see a little bit of sun behind you, or light coming through. I don't think
Yeah,
it's sun.
starting.
Yeah, so it's starting your side. Good luck with the rest of your day. And again, thank you for getting up so early and addressing all of us. To our audience out there, maybe just a very quick reminder. Coming Wednesday, the 7th of Feb, we are starting with our offshore webinars, a series of 3 webinars over 3 Wednesdays. And after that, we'll have our live road shows. Again, to our audience, thank you so much for joining us this morning. It's really a privilege to have you all with us, and thank you for your continued support. Bradley, to you and your team, thank you so much for the good work you're doing. I see Ryan and Anne-Marie also on the call. The audience, if you want any more information, please get hold of us or Ryan or Anne-Marie, and we can get you in touch with the fund managers. Bradley, good luck with your day, and we hope to chat to you soon, and maybe we bump into you when next in SA, I believe it's next week.
Next week, yes. Thank you so much, Eugene. Thank you to everyone.
All the best. Thank you.
Cool.